As a tax professional who regularly has my clients invest in real estate, one of the questions that I am asked most frequently is, what about depreciation recapture taxes, Karlton? Why don't you explain depreciation recapture? I hear you guys. I know this is important to you. So to end all of the confusion and misinformation, I'm going to completely break down depreciation recapture for you in today's video. Make sure you stay all the way to the end of this video. Like many of my videos, I answer tax questions that are relevant right at the end of this video for my subscribers. Without further ado, let's dive in. All right, first things first, what is depreciation recapture? If you're new, you need to understand depreciation recapture from the start. We need to first teach you depreciation. If you're not familiar with depreciation, it is the wear and tear of a piece of property. For example, if you own real estate, depreciation comes in the form of broken appliances, a leaky roof, electrical wiring going faulty, normal things. The IRS knows that certain property that is used for business will tend to break down over time. As a result, it allows business owners to get a depreciation deduction for many different types of business assets. Yes, this includes your rental real estate property. In fact, the IRS allows real estate investors to deduct the entire cost of the building that they own over the course of a few decades. But for residential real estate, that period is 27 and a half years. And for commercial real estate, that period is 39 years. Being able to get depreciation deductions for business property is great, and it can be extremely helpful for business owners and W-2 taxpayers. But here's the thing. Even though the IRS allows depreciation deductions, that doesn't necessarily mean that your business assets always go down in value over time. In fact, for many real estate investors, it's quite the opposite. What I mean by that is that a piece of real estate might increase in value significantly, even though the IRS allows me to get substantial depreciation deductions to offset my taxes. For example, you're a real estate investor, and if you own a duplex that has a building value of, $300,000, this doesn't mean that the value of the building will be worth $0 in 27 and a half years, even though the IRS allows you to write off the full $300,000 over the course of 27 and a half years. In 27 and a half years, the duplex could be worth $1 million, $2 million, $3 million, or even more. The IRS is aware of this, and depreciation recapture is how it balances things out. You see, depreciation recapture is a tax policy that allows the IRS to recapture some of the taxes that they're missing out on by allowing you to claim depreciation deductions for certain assets previously depreciated. Depreciation recapture only comes into play if there is a portion of the gain of the sale that is attributed to the depreciation you've already previously taken. Now, I know that sounded complex, but don't worry, Uncle Karlton's got your back, and I'm going to explain all this in layman's terms for you with a few examples to make it easier to understand. Example number one, let's say you bought a one-bedroom house in Montana with a building value of $200,000 about 13 years ago that you used this property for rental purpose, and you claimed depreciation deductions of $100,000 over the property's lifetime. Now, your adjusted cost basis is $100K. To calculate your adjusted cost basis is by subtracting the amount of claimed depreciation from the purchase price. So, in this case, to calculate your adjusted cost basis for the house, we would subtract the $100,000 that you claimed in depreciation from the $200,000 purchase price. This would give you an adjusted cost basis of $100K. Now, let's say you end up selling the property for $400K. In this case, the IRS would want to recapture taxes on the $100K that you claimed in depreciation. So you would owe depreciation recapture taxes on the $100K you claimed in depreciation deduction, and you would owe capital gains taxes on the other $200K of gain that you experienced when selling the property. Make sense? Let's go to another example. Let's say you bought a two-bedroom condo in Virginia for $300K. 1 year you used as a rental property and claimed $10,909 in depreciation for your first year. But there was a dip in the real estate market, and now you want to sell it, but you can't get $300K for it. So you sell it for $295,000. To calculate adjusted basis, we would subtract that $10,909 from the $300K, which would be about $289,000. And you would not owe any capital gains taxes since you would be selling the property for less than what you bought it for. But you would still have to pay taxes on the depreciation. To figure out how much depreciation recapture there would be, you would subtract the adjusted cost basis of the $289 from the sales price of $295. This would give you about $5,900. So you would owe depreciation recapture taxes on the $5,909. Remember this about depreciation recapture. If the adjusted cost basis is lower than the sales price, you will owe depreciation recapture taxes no matter what if you're claiming it as an investment property. Now, we went over 2 examples, but we didn't talk about how depreciation recapture taxes are calculated. The amount of money that you will owe in depreciation recapture taxes depends on the type of property that you are involved in. There are 2 internal revenue code sections that lay out the rules for calculating depreciation recapture in the event that you decide to sell an investment property. The first code is section 1245 and the second code is section 1250. I really want you to learn this, so please lock in with me. Code section 1245 states that personal or tangible property that is not real estate is subject to depreciation recapture taxes at ordinary income tax rates. Code section 1250 states that real estate assets are subject to a maximum 25% depreciation recapture tax rate if straight line depreciation is used, or ordinary income tax rates if accelerated depreciation is being used. Straight line depreciation means that the full depreciable amount was spread out evenly throughout the useful life of the asset, aka 27.5 years, evenly. So you can expect to pay either ordinary income tax rates or a 25% tax rate on the amount of money that counts towards depreciation recapture when you sell your asset without doing a 1031 exchange. Let me put depreciation recapture into perspective for you. If you're a regular viewer of my channel, then you will know that I constantly talk about the incredible tax benefits of short-term rentals. People who invest in short-term rentals, like Airbnbs, VRBOs, are allowed to use rental real estate losses to offset their active income from their primary day jobs or businesses. This often leads to 50 to 100% reduction in overall taxes. I've seen it a million times. I've explained how depreciation recapture works, but there are several things that I want to say about it and put into perspective. The very first thing that I want to talk about when it comes to depreciation recapture is, who am I speaking to? Am I speaking to a client that's willing to invest in short-term rentals for tax benefits? The first thing that I ask them is, do you believe in real estate? The reason I ask them this is because I only want them to invest in real estate if they're someone who plans to be committed to real estate for the long term. I know that many wealthy people have invested in real estate for the long term to build their wealth. And generally speaking, the longer you hold the real estate, the less of a concern that depreciation recapture is. There are several reasons why this is the case. The first is because property in America tends to increase in value over time. So even if you write off your entire investment in depreciation, you will still likely earn substantial capital gains because your building value could increase by 50 to 100%. There's no way around taxes if you sell your property unless you do a 1031 exchange. Also, you only have to pay depreciation recapture taxes for the amount of depreciation that you claimed based on the original purchase price of the property. So if you own a building worth $200K and you depreciate $200K, but then you're selling the building for $400K, you would only have to worry about paying depreciation recapture taxes on the $200K, the tax incentive the government gave you. You would only have capital gains taxes for the remaining $200K, the actual gain on the property. For many people, long-term capital gains tax rates are also significantly lower than the tax rates that they would have had to pay for depreciation recapture. That being said, you could also choose ways to avoid depreciation recapture taxes entirely. For example, if you never sell the asset that you will plan to pass on to your children, you will never have to worry about depreciation recapture taxes. And this is because if you never sell the asset and hold on to it until you die, the IRS will never have an opportunity to recapture the depreciation. You can then thus pass the assets on to your beneficiaries. Inherited real estate properties are exempt from depreciation recapture taxes. Welcome to the game of taxes, baby. So you're here right now and you have an option to make. You could buy real estate and sell it, or you can leave it for your children and they'll get a stepped up in basis, which means the cost basis gets stepped up to the current market value of the time of inheritance. This also makes the properties exempt from capital gains taxes. Oh, go figure. This favorable tax treatment for inherited properties is one of the main reasons why the wealthy use real estate to pass down wealth to their heirs. They're not just giving cash. 1031 exchanges can also be used to defer depreciation recapture taxes. What is a 1031? A 1031 exchange are when you sell one type of property, buy another like-kind property within 180 days. Swapping one rental property for another in a 1031 exchange will allow you to defer depreciation recapture taxes because two different rental properties qualify as a like kind since they are both rental properties. You can move your assets, aka your appreciation, and roll it over into a new property that's equal or greater value. 1031 exchanges defer both depreciation recapture taxes and capital gains taxes for decades. They call it kicking the can down the road. But here's the bottom line. I know that was quite a lot of information, quite a lot of tax information I laid on you. Well done for making it through this video. You might want to rewatch this video a couple times to make sure you really soak in 1245 property versus 1250 property. But here's the bottom line when it comes to depreciation recapture taxes. If you're really committed to real estate investing and you plan on doing this for the foreseeable future, building your wealth in real estate, borrowing from your equity in the form of a cash out refinance, passing on your assets to your children, then you don't really need to worry about depreciation recapture taxes. Even if you do decide to sell your properties before you die, you could just pay the depreciation recapture taxes if you want. Many people simply use proceeds from the sale of the property to pay the depreciation recapture taxes entirely. Or you can choose to 1031 exchange. If you have any questions about depreciation recapture, if you need help finding the investment property that matches the depreciation you need to offset your taxes, get in touch with my team by clicking on the link in the description below. Now, that is all I got for today's video. I love talking about depreciation. I hope you like this one. And I'm going to answer a question from a subscriber left in the comments on one of my recent videos. This question comes in from Ninoza, and it was on my capital gains tax rate 2024 video that I did a few weeks back. And the question was, one YouTuber, James Connell, says that long-term capital gains are taxed 0% up to the first income threshold, then 15% to the next income threshold, then 20% above. Is that right? That is 100% correct. If you have capital gains taxes, you may not even pay taxes on it because the government has brackets, and the 0% bracket is pretty big. Once you get past the 0% bracket, then you jump into the 15% bracket of capital gains. Once your income is past the 15% bracket, anything in excess past the 15% is then subject to the 20% capital gains tax rate. Guys, you guys have done an incredible job helping me grow this channel, but if you like this video and you're not a subscriber yet, go ahead and hit that subscribe button. We are on a mission to get to 1 million before the end of this year. We're going to continue to put out amazing tax videos for you for the foreseeable future because guess what? The tax code is extremely dense and I'm here to help you out. My name is Karlton Dennis. I'm the uncle that keeps more money in your pocket and I look forward to seeing you on the next video. Cheers.